Hello traders, Nick Shaheen here looking at Microsoft again, not because I want to recommend any which way or another, it's because I was answering a question today and I thought I'd share the answer in the video because it makes sense. So somebody was asking what do they do, do I think it was going up, back up because they were long and they didn't book at the top. So it turns out that they paid 18 cents for Alex. Thanks for the question, by the way. They paid 18 cents to buy a June 220 call. So they've had it for a while. It was as high as 260 or 270, $2.70. So they basically made $2 out of nothing, more than that. But they didn't book. So now it's down to $1.20 or whatever it is. It's still above $1, so it's still a sizable win because they only paid 18 cents. So they quintuples and then some. I'm just doing air math here. So it's a big win. Call it 5-bagger or whatever. So to me, anytime the answer would have been, if they had asked me earlier, anytime I'm wondering about a profit, I book it, lock it, or book some of it, or book all of it. Depends on my personal situation, preference, and the whole portfolio. From 18 cents to 270, I most likely would have booked it. I book early. I leave money on the table, and that's fine with me. But the point of this video is, what can I do now? So they report earnings, I think, late April. If I'm looking at this is Microsoft 200, it's a 4-hour chart. It has had a little correction, and the whole market this week has got, red happens, so it's 7% off the top. Now they say a correction is 10%. Hollywood. Oh my gosh, the Wall Street people. I guess I put them in the same category. So that would bring it to here-ish. Okay, so this down here would be a 10% correction. Now, I don't think it needs to go all the way down here. Let's see what Mr. Fibonacci says. If you want to take this extension, this rally, the 50% would be just below here. So halfway through this gap is the halfway through this rally. So if you want to give back half the rally, you're going to close the gap basically. And to me, this candle is significant. So 174 is significant. If it falls there, I'm a good buyer of Microsoft, given I'm a catch the knife kind of guy. Okay, but what can I do with the call situation? I paid 18 cents. It's now worth over $1. So I'm profitable. I can just book it and say, okay, I missed out the 270, which would have been more than double than what I'm making now, but I'm still making 5 times. So a hell of a lotto, and I shouldn't be upset about booking it. But there are other things I can do. So here's the thing. Let me bring a scratch pad so I can make marks and explain it. So options allow us to buy a call so we can bet upside and not have to invest, $185 or whatever it was, $170 per share. I pay 18 cents to be long 100 shares if I want it at 220. So it's a low odds when he bought it, but look at what happened. So what do I do? So he sold the 220. Bought the, I'm going to put it out here, the 220 June. We'll put a J. And he paid 18 cents for it, right? So that's his cost. That's a maximum you could lose. What I can do is, if I don't want to get out of it, they don't want to get out of it. It's like, okay. So what can I do? I can sell the April 220 call against it. I'm not selling naked calls. I'm selling the same line because I own the longer term one. So if it goes to 1 million, I'm covered. I'm short and long at the same time. And the short one expires before my long one. So there's no way I can lose more than this. But here's the kicker. This brings in almost double that. Last I checked, it was 30-some cents. So by selling the April call, now I will have a call calendar. Okay, so the call calendar usually costs money to enter, and that money that I pay would be the maximum I could lose. In this case, he would be long the call calendar, but by getting paid for it, because he got in early on the one that he bought, and he's selling this one late after the rally. So in essence, he locks his profits, or some of his profits. He cannot lose money. That's the better way to say it. Because he got paid to be long, and there's no extra risk. If it goes to $1 million, he's long and short at the same place. He booked 0.15, let's call it. So he got paid 0.15 credit to actually be long something through June. So if the markets find footing, if the Fed keeps pumping and this stock does this, ideally he wants it to continue on, but not too fast. He wants April, by mid-April, for it not to exceed 220. Why? Because this dies, disappears like it never happened. But the money is in his account. It is in his account. So he collected 0.3 times 20 in this case, times 100. So a bunch of money for doing nothing, just waiting. And then if Microsoft is not above 220 by mid-April, that money's his, and he's still long the leg, which is probably by then will be a lot more than $1, and he's still long Microsoft, and there's an earnings coming at the end of April. So this expires before the earnings. That's the important part. So this is what somebody can do with options. I know this sounds confusing, but it's not. It's like way down here, I don't know when he entered. I didn't know him then. He's new. He bought something for 18 cents. Then Microsoft did this. That 18 cents turned into almost $3. He didn't book it. Then this happened. That $3 turned into $1. I'm using round figures to illustrate. Okay? He's still profitable. He only paid 18 cents. He could just book it and walk away with a fat profit. Or he could now sell something he bought, only shorter time. So he could sell that same contract, only instead of June, sell it for April. And then this way he collects money more than what he paid. So now he collected a net credit in his account for being long. And then the money he collects now is his if Microsoft is under $220 mid-April. And then he is still long the June call that he bought for 18 cents. But he didn't pay 18 cents. He collected 15 cents for it because he paid 18 and then he collected the 35 or whatever. So the net, let's say, credit is 15 cents for round figures. So this is it's a good situation to be in. But we've got the virus and all of that. So there's the risk of Microsoft goes to zero. Not really, but let's say it falls fast. Then both expire for worthless, but he still has the credit he collected. So there's a no-lose situation. No-lose situation. If I sell the April when I already bought this one and I collect the credit that's bigger than what I paid, I cannot lose in this situation. So I know it sounds convoluted, but it's real simple. If you don't know what this all means, in the description down below, I'll put a link to where you can reach me. Maybe we can get together and learn it. All right, Nick signing out.